Shall I start? Silva, shall I start? Respected Chairman, SIRC in absentia, and the on behalf of SIRC, and respected Speaker of the Day, Sri Purohit, and the professionals attending this program, and the office. Namaskaram to you all. And SIRC is continuously organizing nice programs, and among that is today's and the auditing standard on auditing standard on 210 and 560 is today's topic. Being in the auditing and accounting standards committee chairman of SIRC, I've been asked to inaugurate this. I welcome you all to the program. I welcome the speaker for the day, special, who will give you the expertise on this accounting standards. And about the profile of our speaker, Sri Amit A. Purohit is a chartered accountant, and he's a commerce graduate from Mumbai University, and a fellow member of our institute, and also company secretary, and holds a diploma in IFRS of ICAI UK, and is a practicing in audit and assurance services, gap conversion, drafting, advising on internal financial controls, corporate advisory services, taxation, domestic and international, structured cross-border investments, international taxation issues, and foreign exchange regulations, etc. And with regard to the professional activity, institute activities, is a institute and other institutions activities. He is the co-convener of the accounting and auditing committee of the Bombay Chartered Accountants Society. Is a co-opted member of IndAS implementation committee of the ICAI and IndAS technical felicitation group for the year 1920. Technical reviewer with FRRB of ICAI and a peer reviewer. Was a member of the management committee of the Chamber of Tax Consultants, author of publications on tax audit and other certificate publishers by CCH, Walters and Culver. Member of the study group constituted by ICAI on formulating guidance note on service concession arrangements. Had led discussions on variety of topics at various meetings and seminars organized by the professional organization, and has contributed articles for professional journals and newspapers on the topic of the professional interest. I welcome you, sir.
Thank you.
Yes. Yeah, I welcome you, sir. And the floor is yours now. And this is the special program on this accounting standard. I think you can also have questions on this prepared, so that or on his presentation you can have the questions. It will be dealt by him at the last. Yeah. Thank you, sir.
Yeah.
The floor is yours. Go ahead.
Thank
sir.
you. Thank you. Thank you very much, sir, for your kind words and kind introduction. And hello and good evening to all of you who have joined virtually for this particular program. Friends, it's my pleasure to be with you this evening to make presentation on SA 210, which is on agreeing the terms of audit engagement. And I'm also going to take up another essay, which is SA 560 on subsequent event. But before I begin my presentation, I would like to thank SIRC of ICAI for giving me an opportunity to deal with this subject, making this presentation possible. Friends, as you are aware, unlike compliance of accounting standards where the responsibilities are shared with the management. So compliance of the accounting standard is the responsibility of the management as well as the auditor. However, in case of standards on auditing or auditing standards, these are the sole responsibility of the auditor. Auditor is expected and is also required to comply with the applicable standards on auditing while discharging his duty as an auditor. Whenever we take up any audit assignment, there are certain stages, there are always stages in which the audit work is carried out, like planning phase, execution phase, and completion phase. So each of the phases are important in their aspect. So these are the different stages of an audit life cycle, and we have got different standards on auditing dealing with these stages and also dealing with different aspects of the audit. Now, these standards on auditing formulated by the ICAI guide the auditors regarding the documentation, the audit processes, or the procedure to be followed during the audit assignment. Now, so far as SA 210 is concerned, which we are going to deal with today, this standard generally deals with pre-execution stage of the audit assignment. However, it also gives guidance as regards certain situations which may arise during the course of the audit. As the name of the standard suggests, agreeing the terms of the audit engagement with the management is a precursor or the first and foremost process to be followed by the auditor before he actually begins the audit. It establishes the agreement and understanding with the management as regards the scope of the audit, how the audit would be carried out, what would be the deliverables from the point of view of the auditors and from the point of view of the management, what would be the preconditions for the audit which the management has to understand, accept, and acknowledge. So all these things we will see when we begin our actual presentation and when we go through SA 210. Now, I am also going to take up SA 560 on subsequent event. Now, so far SA 560 is concerned, the compliance with this standard is tested by the auditor generally at the end of the audit to ensure that all subsequent events are identified by the management and appropriately reflected in the financial statements, maybe by way of adjustment to the figures of the financial statements or by way of note. This particular standard also talks about auditor's duty or the steps the auditor needs to take to ensure that the said standard is complied with in totality. But first, let me begin my presentation with SA 210, which is like the beginning of the audit process. Friends, so far as companies are concerned, the appointment process is codified under the Companies Act 2013. Now, as you are aware, we have the appointment term of 5 years at a stretch. Once the auditor is appointed by the stakeholders, by the shareholders, there is one important step or the process which the auditor is required to follow, which is the agreeing with the management on the engagement terms, and which finally results into or culminates into audit engagement letter, which is a very important audit working paper or audit document. So with this particular background on SA 210 and SA 560, let me begin my presentation. We will first take up SA 210. I will share my screen. Is the screen visible to you? Is my screen visible, Silva? Hello? Hello? Yeah. So in SA 210, which is on agreeing the terms of the audit engagements, what are the things we are going to cover today in our presentation? First would be the scope of the audit, this particular standard, the effective date from which this standard has come into place, then objective, then what are the requirements of this particular standard, what are the preconditions. This is a very typical term which we need to understand. Agreement and audit engagement terms, then what happens when there are recurring audits, whether we need to exchange audit engagement letter on a year-on-year basis or only one engagement letter taken at the beginning of the first year of appointment would suffice. So that we will see. Then we will also talk about acceptance of change in the terms of the audit engagement. What happens when the audit engagement terms are changed during the course of the audit or during the term of the auditors? So there are certain guidelines given in this particular standard. So we will see those guidelines. And then there are certain additional considerations which the auditor has to keep in mind while doing the engagement acceptance. So this would be the scope of our discussion for this evening. Now, SA 210 is effective for audit of the financial statements for the period beginning on or after 1st April 2010. This particular standard deals with auditors' responsibilities in agreeing the terms of the audit engagement with the management and where appropriate, those charged with the governance. So basically it talks about the auditor's responsibility in agreeing the terms of the audit engagement with the management. And when we talk about those charged with the governance, we mean board of directors or the audit committee, as the case may be. Now, what is the main objective of this particular standard? The main objective is establishing whether the preconditions. I have highlighted this particular term, so we will see the meaning of this in the subsequent slide. But the main objective is to establish whether the preconditions for an audit are present and confirming that there is a common understanding between the auditor and the management or TCWG in terms of the audit engagement. So basically, since the audit engagement letter or the engagement is basically a sort of an agreement, so both the parties, the auditor and auditees, have to come to a common understanding about what would be the scope of the audit and what would be the deliverables from both the sides. So that is the objective of this particular standard. Let's understand what do we mean by preconditions for an audit. It says that this particular standard says that the use by the management of an acceptable financial reporting framework in preparation of financial statements and the agreement of the management and where appropriate TCWG to the premise on which the audit is conducted. So both the parties have to come to an agreement about the acceptable financial reporting framework which the auditee is going to apply while preparing the financial statements. Now let us understand what do we mean by applicable financial reporting framework. The financial reporting framework adopted by the management and where appropriate TCWG in the preparation and presentation of the financial statements that is acceptable in view of the nature of the entity and objective of the financial statements or that is required by law or regulation. So the financial reporting framework which the entity chooses to apply should be acceptable in the eyes of the law or the regulations which govern the entity, or it should be in consonance with the nature of the entity or the objective of the financial statements for which the audit is being done. Then in order to establish that the preconditions for an audit are present, the auditor shall determine whether the financial reporting framework to be applied in the preparation of financial statements is acceptable and also obtain the agreement of the management that it acknowledges and understands its responsibility with respect to. Let us understand what are the points where the management has to acknowledge and understand its responsibility. So these are preparation of financial statements in accordance with applicable reporting framework. Number 2, for such internal control as management determines as is necessary to enable the preparation of the financial statements that are free from material misstatements, whether due to fraud or error. So friends, the primary responsibility or the responsibility of installing the internal controls and ensuring that these internal controls are prevalent in the organization throughout the financial year is cast upon the management. So management through agreeing with the auditor regarding internal controls, the management asserts that it has got the primary responsibility of installing internal controls in the company. Management also understands and acknowledges that the management would provide the auditor with access to all information of which the management is aware and that is relevant to the preparation of the financial statements, such as all the records, documentation and other matters. So this is very important, because unless and until the auditor is provided with access to all the information or documents or records which he wants for the purpose of his audit, he will not be able to conduct the proper audit. So the management has to be very clear, or management has to be appraised about giving access to all the information to the auditors while he discharges his duty as an auditor. Then additional information that the auditor may request from the management for the purpose of audit. For the purpose, say for example, for the purpose of consolidated financial statements, this would include the management of subsidiaries, associates, joint ventures of the entities which gets consolidated. So during the course of the audit, if the company has got certain subsidiaries, associates or joint ventures, the auditor may want to seek certain information, and the management should agree to provide all such information to the auditor. Plus, he has to be given unrestricted access to persons within the entity from whom the auditor determines it necessary to obtain the evidence. So the management should ensure that the auditor has got access to all the persons from whom the auditor wants to obtain audit evidence or certain information for the purpose of doing his duty as an auditor. Now, we discussed about the financial reporting framework, but what are the factors which determine which financial reporting framework would be applicable and acceptable for the purpose of audit? Now, one of the factors would be the nature of the entity. For example, whether it is a business enterprise or not-for-profit organization, the purpose of the financial statements, for example, whether they are prepared to meet the common financial information needs of a wider range of users or the financial information needs of the specific users. So it is a specific tailor-made report to certain specific users, or these are the commonly used financial report given to all the stakeholders. Then the nature of the financial statements. For example, whether the financial statements are a complete set of financial statements or single financial statements. So whether the financial statements being audited are condensed financial statements or the full-fledged financial statements. Whether the law or regulations prescribe the applicable financial reporting framework. So for example, there are certain entities to whom Ind-AS framework of accounting is applicable. To certain entities, accounting normal ICAI is applicable. So the auditor and the management has to be very clear when they execute the engagement letter that what would be the accounting framework which would be applicable to the entity. So if the entity is under the Ind-AS regime, the financial statements would be prepared under Ind-AS. Now, if the preconditions which we discussed in the earlier slides, if the preconditions for an audit are not present, then the first step the auditor would take would be he will discuss the matter with the management, and unless required by law or regulation to do so, the auditor shall not accept the proposed audit engagement if the auditor is determined that the financial reporting framework to be applied in the preparation of the financial statement is unacceptable. So if for a company Ind-AS regime is applicable, however the management wants the accounts to be prepared in AS regime or under ICAI, then this would be unacceptable financial reporting framework and the auditor will not accept the engagement. Or if on certain material aspects the auditor is not able to obtain the agreement of the management, like unrestricted access to all the persons, restricted access to all the documentary evidence and everything, if the management puts certain conditions, then if the auditor feels that he will not be able to complete his duty as an auditor, then he will not accept the engagement. Then it may so happen that management may put certain limitation on the scope prior to the audit engagement acceptance. If the management or those charged with the governance impose certain limitations on the scope of the auditor's work in terms of proposed audit engagement, such that the auditor believes that the limitation would result in disclaiming an opinion on the financial statements, or the auditor will not be in a position to obtain sufficient appropriate evidence to base his opinion, then the auditor shall not accept such a limited engagement as an audit engagement unless it is mandated or required by the law or regulation to do so. So let us take one or two examples, like say for example, verification of inventory obtaining balance confirmation of parties is one of the important audit procedures which the auditor has to follow while conducting the audit. Now, if the management does not give access to the inventory verification or does not give access to the balance confirmation process, then the auditor will not be in a position to assess to get the sufficient appropriate audit evidence to base his opinion. And in that case, if he feels that he will not be able to give his opinion, then he will not accept the engagement. Now, having agreed the audit engagement terms with the management, then the next step would be the agreed terms of the audit engagement shall be recorded in audit engagement letter or some other suitable form of written agreement and shall include. So the standard is very clear that first the auditor will agree with the management on the terms of the audit engagement. Having agreed by both the parties on the terms of engagement, the next step would be to execute audit engagement letter, which is a written form of agreement. That would be the next step. And what are the minimum contents or the mandatory contents of the audit engagement letter? Let us see those. Objective and scope of the financial statements. What would be the objective and scope of the financial statements? What are the responsibility of the auditor while doing his audit? What would be the deliverables by the auditor? What would be the responsibility of the management? Identification of applicable financial reporting framework, which we discussed just now. The reference to the expected form and contents of any report to be issued by the auditor. So in case of company audit, the expected form of the financial statements would be as per Schedule 3 of the Companies Act. Then, and the report, the format of the report of the auditor would be as per the standards on auditing issued by the Institute of Chartered Accountants of India, and the relevant standards would be SS 700, SS 701, SS 705, SS 706. So based on the guidance given in these standards, the format of the auditor's report would be determined. Now friends, many a times the question arises is, say for example, the auditor is appointed. Once he is appointed, he executes the audit engagement letter with the management. Since the term of the auditor is now 5 years under the Companies Act, a block of 5 years, and there are no ratification requirement now. So once the audit is completed for the first year, and now the auditor is going to begin the audit for the second year, second financial year in that block of 5 years, whether every year he has to obtain the audit engagement letter or not. This is a very common question which is discussed and which arises during the course of our audit. So let us understand what are the guidance given in this particular standard 210 on obtaining audit engagement letter in case of recurring audits. It says that following factors may make it appropriate to revise the terms or to remind the entity of the existing terms. So initially it says that you obtain the audit engagement letter at the beginning of the assignment. In the first year you already obtained. However, if there are certain factors which may make it appropriate to revise the terms or to remind the entity of the existing terms, then you go for the revision in the audit engagement letter later on. So what are these factors which may want the auditor to revise the audit engagement letter subsequently? Any indication that the entity misunderstands the objective or scope of the audit, any recent change in the senior management. So if there is any change in the management of the company and the previous audit engagement letter was executed with the earlier management, and if the auditor feels that I also need to ensure that the new management also understands the objective and scope of the audit and it needs to be codified, then he will execute a new engagement letter. If there are any significant change in the ownership structure of the company, say for example, if the parent company has changed or if the shareholding pattern of the company has changed, then the auditor may think of issuing a fresh audit engagement letter. If there are any significant change in the nature or size of the business entity's business, a change in the legal or regulatory requirements, a change in the financial reporting framework adopted in the preparation of the financial statements. So say for example, if in the first year the IFC audit was not applicable to a particular entity, because under the Companies Act, the auditor has to also report on the internal financial controls, which is done by way of an annexure to the main audit report. So when the auditor executes the audit engagement letter, he also mentions that he will be issuing a separate audit report on the internal financial controls of the entity. Now, say for example, it was not applicable in the first year of engagement, and in the subsequent year, this IFC framework is applicable to the entity, and the auditor will have to give the report. Then the auditor may think of revising the audit engagement letter, whereby he will draw the attention of the management to the fact that now the auditor will also give his opinion on internal financial controls. And friends, since we are on IFC, there is a guidance note of the institute on IFC, where it has also given a format of the audit engagement letter. And when you are giving a separate engagement letter for IFC audit, in the main engagement letter, you will also give a cross reference to the separate engagement letter for you are giving for IFC audit. Then if the earlier the entity was under AS regime and subsequently the entity comes under Ind AS regime, then the auditor may also draw the attention of the management about change in the financial reporting framework, and for that the auditor may think of giving us new audit engagement letter in the subsequent year when it becomes applicable, or if there are any change in the other reporting requirements. So say for example, if there are now CARO 2020 has come and there are certain other reporting requirements under Schedule 3. So if the auditor wants to draw the attention of the management about certain new requirements in CARO 2020 or Schedule 3, then he may include these new items in the fresh audit engagement letter. Again, all these things depend from case to case basis. Now, acceptance of a change in the terms of the audit engagement. The auditor shall not agree to a change in terms of audit engagement where there is no reasonable justification for doing so. So if the management wants to change the terms of the audit engagement where there is no reasonable justification for doing so, then he will not accept this change in the terms of the audit engagement. Some of the reasonable justifications are change in circumstances affecting entities' requirements, or there were some certain misunderstandings in the earlier audit, but now the management has understood the scope, then there is no need to change the audit engagement letter. If before completing the audit engagement, the auditor is required to change the audit engagement to an engagement that conveys a lower level of assurance, the auditor shall determine whether there is a reasonable justification for doing so. So say for example, if the management wants, this will be a very rare circumstances, but if the management wants to convert this audit assignment into a very specific assignment on us, say for example of verification of debtors or inventory or certain certification of the financial statements, which is not in the nature of audit, then the auditor will not accept the changes in terms of the audit engagement. Then if the auditor is unable to agree with the change terms of audit engagement and is not permitted by the management to continue the original audit engagement, the auditor shall withdraw if possible under applicable law or regulation and determine if the circumstances need to be reported to other parties such as those charged with the governance, regulators, owners. So say for example, if the auditor is not agreeable to the change in terms of the audit engagement, then there are certain requirements under Companies Act, there are certain requirements of reporting under SEBI guidelines. Then before he withdraws from the engagement, he has to be very clear about the ROC reporting requirement, SEBI reporting requirement. And now the institute has also come out with a publication on withdrawal from the audit engagement. So the auditor has to be very clear about the steps which he has to take before he withdraws from the audit engagement. Now I'll just draw attention to one of the requirements of SEBI is that if the auditor wants to withdraw from the engagement, then he has to complete the audit of a particular quarter for which he was doing the audit. So there are certain requirements as per SEBI also. Now, also under ROC, the auditor has to give reason for resigning because he has to file Form ADT. So the auditor has to be very clear about, he has to give a very clear reasoning while resigning also. If the terms of the audit engagement are changed, the auditor and management shall agree on the new terms. This we have already discussed. Additional considerations in engagement acceptance. When the auditor's report is prescribed by law or regulation, then the auditor will evaluate whether the users might misunderstand the assurance obtained from the audit of the financial statements, and if so, whether the additional explanation in the auditor's report can mitigate possible misunderstanding. If the additional explanation cannot mitigate the possible misunderstanding, then he should not accept the audit engagement. So say for example, friends, when we are doing the tax audit, if we see the format of Form 3CA or 3CB, because it has to be filed on the income tax portal, so it has got certain limitations about the paragraphs which can be inserted. It comes with a certain prefixed paragraphs. So then the auditor has to see whether he needs to put certain additional paragraphs as per the guidance note on tax audit, because if you see the guidance note on tax audit, it requires the auditor to place certain paragraphs about auditor's responsibilities, management responsibilities in Form 3CA, 3CB. So the auditor might evaluate whether you want to use this paragraph to make sure that the users of the tax audit report understand the limitations of the audit and what is the scope and objective of the tax audit. Now let us understand what are the general or normal contents of the engagement letter. Friends, we all are aware about SA 210. However, the institute has also come out with implementation guidance on this particular essay, which gives a very clear-cut and concise guidance about the process or procedural, and it is a very practical tool for the auditor to apply. It has got few questions and answers. It also comes out with a checklist. So I would urge the members who are right now there in this particular seminar to go through this implementation guide issued by the institute. It is a very beautiful publication, and it also gives the format, draft format or the model format of the audit engagement letter, which you may want to use for the purpose of your audit engagement letter, which you are going to execute with your audit clients. So now let us understand what are the general contents, or this can be maybe minimum contents which the engagement letter should have. The first one is the audit engagement letter should have a reference to the appointment letter. So the engagement letter would generally start with a reference to the appointment letter, about the date of the appointment letter, and this engagement letter always succeeds the appointment letter. So first the appointment takes place, then the auditor goes into engagement mode and he executes audit engagement letter with the management. So the engagement letter has to give reference to the appointment letter. Then the engagement letter is supposed to give the period of the financial statements. So it will mention the period for which the auditor would be auditing the financial statements. So it has to be very clearly mentioned in the engagement letter, because it is like an agreement between the two parties. Then there will be a reference to the contents of the financial statements, including consolidated financial statements, balance sheet, P&L, CFS. So the audit engagement letter should also mention what would be the contents of the financial statements. When the auditor writes that he will audit the financial statements, what would be the contents of the financial statements, like balance sheet, P&L, cash flow statement, statement of changes in equity. If the auditor is also going to audit the consolidated financial statements, then he will also mention the same in the audit engagement letter. Then the reference to the objective of the audit means elaboration of the scope of the audit. What would be the scope of the audit? Now friends, the scope of the audit is determined by the relevant provisions of the Companies Act the guidance given in the standards on auditing issued by the ICAI, applicable legislation, Companies Act, SEBI guidelines, other ethical and other pronouncements of ICAI. So this objective of the audit will be culmination of all these regulatory requirements. Then reference to the reasonable assurance and not a guarantee. So friends, we need to be very clear in while executing engagement letter that whenever the auditor is doing any audit and when he issues any audit report, it is not an absolute guarantee that the financial statements are free from material misstatements, but he is giving only reasonable assurance, which is a very high quality assurance. Many a times the management understands that, or the perception in the general public is that the auditor gives absolute guarantee that there are no misstatements in the financial statements. However, the auditor has to be very clear in reciting in audit engagement letter that the audit process would culminate in issue of audit report, but where he will give a reasonable assurance but not an absolute guarantee about the misstatement in the financial statements. Then he has to also give the reference to the responsibility of the auditor. What would be the responsibility of the auditor? The responsibility of the auditor would be guided by the requirements of the Companies Act and the relevant pronouncement of the institute and the standards on auditing. Then reference to the reporting to central government under section 143(12) relating to fraud. So the typical audit engagement letter should also have a particular paragraph on reporting requirement to central government under section 143(12) relating to fraud. So as you are all aware that there is a particular process mentioned under this particular section whenever auditor comes across fraud or whenever he is informed about any fraud by the management. So he has to inform the management or those charged with the governance, and subsequently if the amount of fraud is above certain threshold, then he has to also inform the central government. So the auditor has to be clear, in the audit engagement letter, the auditor has to clearly mention that he will be duty bound to report the frauds to the central government. And friends, since we are on the fraud, one may also check the guidance note of the institute issued on fraud reporting. Then a reference to the responsibility of the management for those charged with the governance. So the audit engagement letter has to clearly specify what would be the responsibilities of the management or those charged with the governance. So say for example, if you see the framework of the Companies Act regarding financial statements, audit, etc., certain duties have been cast on the management or those charged with the governance about certain preparation of the financial statements, installation of internal financial controls, etc. So the auditor has to clearly remind the management that these are your responsibilities when we do the audit or when you prepare the financial statements. Then reference to the request of the annual report. It is regarding auditor's responsibilities relating to the other information specified under section 143(10), read with SA 720. So the auditor is also required to go through the annual report, and if he feels that there are certain information which are inconsistent with the financial statements or whatever he has reported in his audit report, then he will have to follow certain processes. So the auditor will have to clearly mention in the engagement letter that he will be requesting annual report from the management. Then reference to the expected form and content of any other reports to be issued by the auditor. Requirement of the auditor to communicate key audit matters in the audit report in accordance with SA 701 on communicating CAM in the independent auditor's report. So the audit engagement letter, wherever reporting under 701 is applicable, mainly say for example in case of a listed entity, this particular recital in the audit engagement letter should come that the auditor is required to communicate certain key audit matter in his audit report. So that should be clearly mentioned in the audit engagement letter. the fact that because of the inherent limitations of an audit together with the inherent limitations of internal control, there is an unavoidable risk that some material misstatements may not be detected even though the audit is properly planned and performed in accordance with the standards on auditing. This we have already discussed, that audit will never result in giving absolute assurance, but there will be a reasonable assurance. The agreement of the management to inform the auditor of the facts that may affect the financial statements of which the management may become aware during the period from the date of auditor's report to the date of financial statements are issued. Again, this particular whatever is mentioned in this particular paragraph, we are going to look at it when we discuss SA 560. So it is basically talking about subsequent events. So if the management becomes aware of certain facts which happen between the date of the financial statements and the date of date when the financial statements are issued or after the auditor's report, then the management has to promptly inform the auditor about these facts so that the auditor can take reasonable steps which are mentioned under SA 560. Then he will also refer to the reliance on other auditors like branch auditors, other experts, etc. So the auditor may have to take help from other experts, then he will clearly mention. Then it refers to the matters to be communicated to those charged with the governance. So during the course of the audit, the auditor may come across certain queries or certain queries regarding the controls, internal controls. Then he may want to communicate these matters to the management or those charged with the governance. Then he will communicate these matters to. Then the audit engagement letter should also include protective clauses on data transfer, working papers, etc. So friends, as you all are aware, the working papers which the auditor generates during the course of his audit is a sole property of the auditor. The working paper will always belong to the auditor and it will not belong to the management. So it has to be very clearly spelled out in the engagement letter that this will belong to whatever data the auditor gathers or whatever work papers he prepares will be the sole property of the auditor. Then a reference to the requirement of UDIN. Now this is a very unique and new development. Friends, as you all are aware, UDIN has come since past couple of years. Now whenever we generate any UDIN, when we issue any audit report, the website or the portal of UDIN requires us to give certain financial information or certain financial parameters, figures of certain financial parameters. So the auditor has to clearly mention in his engagement letter so that the management becomes aware that at the end of the audit, whenever the auditor issues final audit opinion, then he would be required to generate UDIN on the web portal of ICAI, where he will be punching certain information about the auditee. It should be very clearly spelled out in the audit engagement letter. Then the basis on which the fees would be computed or any billing arrangements. The fact that the audit process may be subject to peer review under the Chartered Accountants Act 1940. So again, this is very important. The audit engagement letter should clearly have a paragraph on the peer review process which the auditor may undergo. So he has to, the auditor needs to appraise the management that he may be subject to a peer review process whereby the whatever the working papers collected by him during the course of audit may be subject to a review of the peer reviewer. Any other legal requirements, for example, paragraph 6 of SEBI circular of October 2019 with regard to resignation of statutory auditors from listed entity and their material subsidiaries. So again, like we discussed this particular subsequent this circular a few slides back, then auditor is duty bound to follow this circular. So the auditor has to clearly mention in his audit engagement letter and communicate to the management that he will have to comply with this particular SEBI circular and he cannot just withdraw from the engagement. Limitation on damages. He may the auditor may want to restrict the damages which can be levied on him. Then confidentiality matters. So friends, as you all are aware, the pivotal, the audit is the very foundation of the audit is confidentiality of the client. the whatever information which the auditor come across during the course of audit is kept confidentially by the auditor. So he will clearly mention that the information which he will gather during the course of the audit will remain confidential unless it is required by certain government authorities or regulatory authorities. Then he may have to share this information. Reference to separate engagement letter for the audit tender, section 143(3)(1). So like we discussed before, in case of audit for IFCs, then he will have to execute separate audit engagement letter, and he will give a cross reference in the main audit engagement letter. A request for management to acknowledge the receipt of the audit engagement letter and to agree to the terms of the engagement outlined therein. So normally, if you see typical audit engagement letter, the last paragraph would be where the auditor would request the management or those charged with the governance that you acknowledge the receipt of the audit engagement by signing it, so that we understand that you have understood the objective and you agree with the terms of the audit. So the audit engagement letter will normally culminate in signing by both the parties. And that is when we can say that the audit engagement letter has been executed. Now let us understand, many times the question arises is with whom the terms of the audit engagement be agreed upon. Now if we see the guidance says that the terms of the audit engagement would have to be agreed with the management or those charged with the governance as appropriate. In case of companies, those charged with the governance would include audit committee, board of directors. In case of a partnership firm, the term needs to be agreed with the partner of the firm. In case of a trust, it would be trustee. And whenever a person, in case of a company audit, if a person signs the audit engagement letter, the auditor has to be very clear in understanding that the person who has signed the audit engagement letter has the appropriate level of authority given by the board or audit committee to execute this audit engagement letter on behalf of the board of directors or audit committee. Now this is a very many times this question arises is that the auditor has, as a part of the audit procedure, whenever he is beginning the audit process, the auditor has very nicely drafted the audit engagement letter. He has discussed the points with the client, and then he finally shares the hard copy of the audit engagement letter with the auditee. However, the auditee or the client has not returned the copy of the audit engagement letter by signing on it. So in such situations, what is the guidance given? So let us understand that particular guidance. Now, as per the general clarification issued by the Auditing and Assurance Standards Board of ICAI on SA 210, the auditor and the client are normally considered to be agreeing on the terms of the engagement if the objective and scope of an audit and auditor's obligations are laid down in the statute or regulations governing the engagement. In such cases, it is not necessary that the engagement letter sent by the auditor is acknowledged by the addressee or the auditee and returned to the auditor to establish that the client's understanding of the terms of the engagement is in accordance with the engagement letter issued by the auditor. In such cases, it shall be sufficient compliance with the requirement related to sending the audit engagement letter if the engagement letter is appropriately delivered to the client and the auditor retains the evidence of such delivery. In such cases, the audit engagement letter would be informative for the clients. For example, like audit under section 139 of the Companies Act 2013, audit of public sector banks. So now, friends, the scope of the audit, the responsibility of the auditor, the responsibility of the management have been clearly spelled out under the Companies Act. And if you are doing the audit of the company, then once you have communicated the terms of the engagement verbally to the management and followed by a written audit engagement letter, and if for some reason the management is not signing the audit engagement letter, then it is fine. so far as you have got an evidence in your hand that you have delivered the audit engagement letter to the client. However, in my view, we should strive, if possible, we should strive to get the signed audit engagement letter copy from the management. Now let us take few questions. Who can sign the engagement letter on behalf of the firm? So we are talking about the auditor side. Now this engagement letters needs to be signed by the partner or proprietor of the firm, as the case may be. So it can be signed by any partner. Who can sign the engagement letter on behalf of the auditee? Now we are talking about the other side, the, say for example, company. Again, the engagement letter needs to be acknowledged by the appropriate level of the management who have been conferred the power by the board of directors. In case of companies, in case of partnership firms or LLP, it can be signed by a partner. In case of a trust, it can be signed by the trustee. So like I mentioned before, in case of a company, if the person who is signing on behalf of the management, the auditor has to make sure that he has got appropriate level of authority given by the board of directors. If that is the case, then that person can sign on behalf of the board. Or in case of LLP, it would be any partner who has been authorized by the other partners. Or in case of trust, it can be signed by the one of the trustees. In case there are more than one auditor which are appointed to conduct the audit jointly and report on the financial statements of the entity, should each of the auditor enter into a separate engagement letter or not? Now, many times there are joint auditors which are appointed to do the audit of the company, and in such cases, the question arises whether there is to be, say, for example, if there are two auditors appointed by the entity, then each auditor will execute a separate audit engagement letter with the entity, or there has to be a common engagement letter between these three parties. So on one side is the management, on the other side are two auditors. So the response is very clear that in case of the joint audit of the financial statements, the joint auditor shall obtain common engagement letter. So it will be a tripartite sort of an agreement. Should a separate engagement letter be sent to component where the auditor of the parent entity is also the auditor of the component? Say for example, branch or a subsidiary. So if you happen to be the auditor of the holding company, at the same time you are also the auditor of the subsidiary company or joint venture or associate. So these are known as components. Now question arises, since you have already executed the audit engagement letter with the management of the holding company, do you still require to execute audit engagement letter with the subsidiaries or joint venture or associates or not? Now again the guidance is given, and it is like this. When the auditor of the parent entity is also the auditor of the component, the factors that may influence the decision whether to send a separate audit engagement letter to the component will include the following. Who appoints the component auditor? Whether a separate auditor report is to be issued on the component or not? What are the legal requirements in relation to audit appointments? Degree of ownership by the parent, degree of independence of the component management from the parent entity. So if you see the framework of the companies that which all the Indian entities are bound to follow, then for subsidiary companies there is a separate process. Like the holding company, there is a separate process to be followed for the appointment of the auditors. It is a separate legal entity, and generally in case of subsidiaries, a separate audit engagement letter is executed with the management of the subsidiaries. Friends, with this we have completed our first stage of discussion, which was on SA 210 on audit engagement letter. Now let us move on to the second topic, which is SA 560 on subsequent events. Friends, just a moment, I'll just have a water and I will begin. Now let us understand the scope of this particular standard. This standard is effective for the audit of the financial statements for the period beginning on or after 1st April 2009. This AC deals with the auditor's responsibility relating to the subsequent events in the audit of financial statements. It does not deal with the matters relating to auditor's responsibility for other information obtained after the date of the auditor's report, which are addressed in SA 720. So the scope is very clear that whatever is dealt with under SA 720, it will be excluded from the scope of this particular standard, which is 560. Now let us understand what are the twin objectives of this particular standard. The first objective is to obtain sufficient appropriate audit evidence about whether the events, this is very important friends, whether the events occurring between the date of the financial statements, so say for example the date of the financial statement is 31st March and the date of the auditor's report, which will be subsequently, say for example 31st of May, in the date of the auditor's report that requires adjustment of or disclosure in the financial statements are appropriately reflected in those financial statements. So the auditor has to obtain sufficient appropriate audit evidence by following the processes mentioned in this particular standard and by following the other processes which are mentioned in other applicable standards on auditing to ensure that whatever events which happen between the date of the financial statements and the date of the auditor's report, they are appropriately reflected in the financial statements. Now some of the event may require adjustments, some of the events may require disclosure. However, the auditor's duty would be to ensure that these are appropriately reflected in the financial statements. Then the another objective of this particular standard is to respond appropriately to the facts that become known to the auditor after the date of the auditor's report, that had they been known to the auditor at that date may have caused the auditor to amend the auditor's report. Now under this standard, the auditor has to respond appropriately to the facts which becomes known to him post the date of the auditor's report. So once he has signed the auditor's report and he comes to know about certain facts which may have, if those facts would have known to him earlier to the signing of his audit report, then it would have made him to amend the auditor's report. Then he has to respond appropriately, and that guidance is given in this particular standard. So we will see those guidances, how he would, what are the steps he would take when the facts become known to him. Let us look at certain definitions which are given in this particular standard. What do we mean by subsequent event? This is a very core substratum of this particular standard. So we need to be very clear in our understanding of the subsequent event. Subsequent event is an event occurring between the date of the financial statements and the date of auditor's report and the facts that become known to the auditors after the date of the auditor's report. So there are two things in this particular definition. One is the event which occur. This is the first point. Events which occur between the date of the financial statements and the date of the auditor's report. That is the first limb of this definition. And the second limb is the facts which come to his light after the date of the auditor's report. Now, friends, this standard on subsequent event gives guidance to the auditor regarding the process he has to follow when subsequent events are brought to the light of his during the audit. There is also a accounting standard 4 on event occurring after the balance sheet date. It gives the accounting framework or the accounting guidance as regards what process the management and the auditor has to follow. So if we see the interplay or intersection between these two standards, one auditing standard and one accounting standard, the accounting standard gives guidance on the accounting aspect. The auditing standard, which is SA 560, gives guidance on the steps which the auditor has to follow in identifying and in taking note of the subsequent events. So this AS4 is applicable both to the auditors as well as to the management. This subsequent event compliance is applicable to the auditors. Again, if we see the meaning of events occurring after the balance sheet date as per AS4, it is pretty narrow compared to the subsequent event definition under SA 560, in the sense that if you see the definition of AS4, it talks about the event which happens between the date of the balance sheet and the date when the financial statements are approved. So it means the date of the balance sheet and the date when the board of directors approve the financial statements. So that is the period which AS4 covers, and it gives the guidance. So far as SA 560 is concerned, it gives guidance from the date of the balance sheet till the auditor's report date, and also to certain facts which comes to his light or which are brought to his knowledge by the management subsequent to the signing date. So it is much broader in scope compared to AS4. Now let us understand what do we mean by date of approval of financial statements. Friends, as you all are aware, it is the date on which all the statements that comprise the financial statements, including the related notes, have been prepared, and those with the recognized authority have asserted that they have taken the responsibility for those financial statements. So in short, the date of approval of the financial statements in case of company would be the date of the board meeting approving the financial statements. Then date of the auditor's report. It is the date the auditor dates the report on the financial statements in accordance with SA 700. The date of the auditor's report, in short, is the date which he puts in the auditor's report. So when auditor puts the date on the audit report, he claims or he takes the responsibility of the event which have happened till the date of his signature, which have come to his light. So this date of auditor's report is very important in the context of this particular standard. Date when the financial statements are issued. Now this is another term which is finding place in this particular standard. So till now we have seen the definition of the date when the financial statements are approved, which is the board of directors. Now it is the date the financial statements are issued. So normally the date the financial statements are issued will always succeed the date on which the financial statements are approved. Let us understand the meaning of this term in the context of this particular standard. It is a date that the auditor's report and the audited financial statements are made available to third parties. Now, third parties would indicate a wide range of stakeholders like bankers, shareholders, regulators, etc. So in case of listed entities, the date of submission of the results to the stock exchanges would be considered as the date the financial statements are issued, irrespective of when the notice calling the AGM, board report, and full set of financial statements with all the notes and disclosures are subsequently issued to the shareholders. This date of the financial statements are issued can also mean the date the financial statements are issued could also be the date when the auditor's report in the audited financial statements are provided to any third party. This could also mean the date the financial statements are issued would be the date when the notice calling the AGM is sent to the shareholders along with the board report and the auditor's report and the audited financial statements. So if we see this definition, it envisages three situations. One is the situation where the results are this will happen in case of listed entities. So when the results are communicated to the stock exchanges, when we can say that the financial statements are issued. In case of non-listed companies, it can also mean that when the notice calling the AGM is sent to the members along with the full set of financial statements along with the board report, auditor's report, then we can say that the financial statements are issued. Or in case of, it can also mean when these financial statements along with auditor's report or board of directors are issued to any third party. So again, it depends from facts and circumstances of each case. However, the standard gives a broader guidelines about when the financial statements would be deemed to be issued. Now, under this particular standard, the auditor is required to make certain inquiries about the subsequent events, or there are subsequent events. There are certain sets of subsequent events which may happen between the date of the financial statements and the auditor's report date, which prompt the auditor to make certain inquiries with the management, and he has to follow certain audit procedures. Now, what are the events which can trigger such review by the auditors? So these are new commitments, borrowings or guarantees that have been entered into by the management, invocation of force majeure clause after the year end by any party, recent or planned sales or acquisition of assets, impact on realizable value of inventory of a short-term nature, indications of impairment in the value of investments in companies, assets appropriated by the government or destroyed. So these are whole host of, these are certain examples. Again, the auditor will have to go into particular facts and circumstances of each case, and these are just broad indicators. It does not mean that in every case there will be a subsequent event adjustment in the financial statements. However, these events prompt the auditors to follow certain guidelines given in this particular standard. Now, so far as the process to be followed by the auditor, it gives three different situations. This standard on auditing gives three different situations in which it says how the auditor would respond. The first situation would be event occurring between the date of the financial statement and the date of the auditor's report. So this is the first situation which is envisaged under this particular standard. Then the second situation would be the facts. Now, so in the first limb we talked about the events. Now we are talking about the facts. So second and third situation are relating to facts. So what is the meaning of the second situation? Let us understand that the facts which become known to the auditor after the date of the auditor's report. So in the first situation, we talked about the events which have arisen up to the date of the auditor's report. Now certain facts have become known to the auditor after the date of the auditor's report, but before the date of the financial statements are issued. So this is a second bracket or the second basket which happens from the date of the auditor's report till the date the financial statements are issued. But in this case, the financial statements have not been issued. Now let us go to the third basket or third bucket and see what is the third situation. The third situation encompasses the facts which become known to the auditor after the date of the auditor's report, but after the date of the financial statements are issued. So these are the three unique situations which can arise, and it says that what would be the procedure the auditors would follow. In both these situations, the second and third situation, it may warrant amendment in the financial statements, or it may not require amendment to the financial statements. It may so happen that the management may amend the financial statements, management may not amend the financial statements, and maybe it may so happen that the auditor does not agree with the non-amendment of the financial statements. So it clearly gives the guidance regarding the steps the auditor would follow. Let us understand the first scenario, which is events occurring between the date of the financial statements and the date of the auditor's report. And the guidance is like this: the auditor shall perform audit procedure designed to obtain sufficient appropriate audit evidence that all the events occurring between the date of the financial statements and the date of the auditor's report that require adjustment or disclosure in the financial statements have been identified. Now, if we look at this particular point, it says that it casts the responsibility on the management that whatever subsequent events which happen have to be identified by the management and clearly informed to the auditor. Then the next step would be obtaining an understanding of any procedure management has established to ensure that subsequent events are identified. Now friends, it is not that the management has just communicated, say for example, a couple of matters to the auditors which they have identified. The auditor has to see the design of the controls which the management has installed in the organization to ensure that whatever subsequent events which happen are identified through the system itself and not as an exception. So obtaining the understanding of any procedures the management has established to ensure that subsequent events are identified. Then next step would be inquiring of the management and TCWG as to whether any subsequent events have occurred which might affect the financial statements. So first he will see that the management has established controls to to throw open the subsequent events by which the subsequent events are identified. Having satisfied himself that these controls exist, then he will follow the next step, which would be inquiring with the management. So he will sit with the management to check whether any subsequent events have occurred which might affect the financial statements. He will also have to follow certain audit procedures like reading the minutes of the meeting of the shareholders, management, board of directors that have been held after the date of the financial statements, and inquiring about the matters discussed at such meetings for which minutes are not yet available. So whatever minutes, whatever meetings which have happened post the balance sheet date but till the auditor's report date, if there are certain meetings which have been held, the auditor will be asking the minutes of such meetings. He will go through the minutes to check whether there are identifiable subsequent events which requires any adjustment in the financial statements or not. So there is a duty cast on the auditor to ensure that he follows certain processes as given under 560, which is like reading the minutes of the meetings, inquiring with the management, checking the system whether it ensures that subsequent events are identified, reading the entity's latest subsequent interim financial statements. So if there are subsequent interim financial statements of the entity are available, the auditor would ask these financial statements from the management. He will go through this financial statement to check that are there any situations which can be identified as subsequent event, and because of that there are any adjustments required in the financial statements or not. And if there are no interim financial statements available with the management, then he may want to go through the MIS MIS statements which the management has prepared for its internal information. Then, when as a result of the procedures performed, which we discussed in the previous slide, the auditor identifies the event that require any adjustment or disclosure in the financial statements, the auditor shall determine whether such event is appropriately reflected in the financial statements. So the next step is very clear. After having performed all the processes which are mentioned in this standard, the auditor has identified, either there will be two scenarios. The auditor will identify the subsequent procedures, or he will be satisfied that there are no subsequent events. Now, if there are no subsequent events, then there will not be question of any adjustment to the financial statements or any disclosure in the financial statements. But if by following these procedures, if he come across a certain subsequent events which requires any adjustment in the financial statements, then he will determine whether each such event is appropriately reflected in those financial statements. So how he will ensure that these are appropriately reflected in the financial statements? He will request the management to make changes or to make additions or deletions in the financial statements, adjustments to the figures of the financial assets or liabilities, or by giving appropriate note in the financial statements. And if the management has agreed and adjusted the financial statement, then these procedures are complete. The auditor, as a part of the procedure to be followed, the auditor will also request the management, wherever appropriate, those shall be the governance, to provide a written representation in accordance with SA 580 on written representations, that all events occurring subsequent to the date of the financial statement and for which the applicable financial reporting framework requires adjustment or disclosures have been adjusted or disclosed. So even after following all these processes and auditor has been satisfied, he should obtain a written representation from the management in his management representation letter that management has identified all subsequent events, and wherever this subsequent event required any adjustment to the financial statements, all these adjustments have been appropriately reflected in the financial statements. But friends, we have to be very clear, just by obtaining the MRL is not sufficient. Auditor has to demonstrate clearly that he has performed all the steps which we discussed in the previous slides. And like I always say that the written representations or the management representation letter is the last defense. First, at the very beginning of your defense, you have to demonstrate that you have carried out the audit procedures in accordance with the requirements of different account auditing standards. And so far as identification of subsequent events are concerned, he has clearly performed the processes as per SA 560. Having understood the first scenario, let us go to the second scenario, which is facts which become known to the auditor after the date of the auditor's report, but before the date of the financial statements are issued. Now, what are the steps the auditor will take under this particular scenario? Now, under this particular scenario, generally, the auditor has no obligation to perform any audit procedures regarding the financial statements after the date of the auditor's report. So once having issued the auditor's report and having made inquiries into subsequent events and he is satisfied, then the auditor is not required to perform any additional processes. However, when after the date of the auditor's report, but before the date of the financial statements are issued, a fact becomes known to the auditor that had it been known to him at the date of the auditor's report may have caused the auditor to amend the auditor's report, the auditor shall follow these three steps. The first step is he will discuss the matters or the facts which has come to his light. He will discuss the matter with the management and those charged with the governance. The next step would be to determine whether the financial statement need any amendment, and if so, in the next step he would determine whether he will quantify whether the financial statements need any amendment or not. Then he will inquire how the management intends to address the matter in the financial statements. So these three steps are very clear. First, he will discuss the matter with the management. In the second step, he will determine based on the discussion whether any amendment to the financial statement is required or not. If he comes to the conclusion that there is an amendment which is required in the financial statement, then he will check with the management how management intends to address this matter in the financial statements. So these are the three broad steps. Now, having concluded that the financial statements require the adjustment because of the subsequent event, and in the scenario where the financial reporting framework or the regulation allows the entity to amend the financial statements, then there are two options available with the auditor. So in case of company set also, the framework allows the company to amend the financial statements, which we will see later on. But if the law allows, then there are two possibilities available to the auditors. The first one being amend the auditor's report to include an additional date. Amend the auditor's report to include an additional date restricted to that amendment. That thereby indicates that the auditor's procedures on the subsequent event are restricted solely to the amendment of the financial statements described in the relevant note to the financial statements. So what would happen in this case is that auditor has already given the report. He has already done the dating. However, because of the identification of subsequent event and because of the adjustment to the impending adjustment to the financial statements, auditor would put another date below the original date, which will indicate that he has done his procedure so far as this amendment is concerned. So it will be a dual dating, and the concept of dual dating we will understand in the subsequent slide. Then he has got another option also available, which is to provide a new or amended audit report that includes the statement in EOM paragraph or other matter paragraph that conveys that the auditor's procedure on subsequent events are restricted solely to the amendment of the financial statements as described in the relevant note to the financial statements. So friends, whenever auditor issues either a new report or whenever auditor does the dual dating, the meaning is very clear that the auditor has performed the audit procedure only in respect of the adjustment which has been made in the financial statements, and he has not performed any other procedure for any other things. So it has to be very clear, it has to be understood very clear that the amended report or the dual dating is only restricted to the amendment required in the financial statement because of identification of subsequent event. Let us understand what is dual dating. When the auditor amends the auditor's report to include an additional date, restricted to amendment of the financial statements by the management. The date of the auditor's report on the financial statement prior to their subsequent amendment by the management remains unchanged, because this date informs the reader as to when the audit work on those financial statements was completed. However, an additional date is included in the auditor's report to inform the users that the audit procedures subsequent to that date were restricted solely to the subsequent amendment of the financial statements. And following is the illustration, that which is date of the original audit report as to note so and so, which is of date so and so. So there will be dual dating. So if you were to take this practical example, so in the bracket, date of auditor report would be the original date of auditor's report, say for example 31st May 2022, except as to note Y, which is of dated 23rd June 2022, and which is restricted only to the amendment described in note Y. Now, if the auditor is of the opinion that the financial statements are required to be amended, however, the management do not want to amend the financial statements, then again the standard gives the very clear guidance as to the processes which the auditor is required to follow. And the processes are like this. If the auditor's report has not yet been provided to the entity, then the auditor shall modify the opinion as required under SA 705 and provide the auditor's report. So in the first situation, if the auditor has not shared the audit report with the management, he has not issued the auditor's report, then because of the adjustment required for the subsequent event, however the management has not made the adjustment in the financial statements, then there will be a misstatement in the financial statements, and because of which the auditor will have to give modified opinion or the qualified opinion. Or the second situation, if the audit report has already been provided to the entity, then the auditor shall notify the management not to issue the financial statement to third parties before the necessary amendments have been made. If the financial statements are nevertheless subsequently issued without the necessary amendments, the auditor shall take appropriate action to seek to prevent reliance on the auditor's report. So in the second situation, if the auditor's report has already been shared with the management, then the auditor will write a communication to the management. He will inform the management that please do not share this audit financial statements with the third parties. However, if the financial statements have been shared with the third parties without any necessary arrangements, the auditor shall take appropriate action to seek to prevent reliance on the auditor's report. And these are the example of the action required by the auditor in such scenario. He will first notify the client that the auditor's report should no longer be associated with the financial statements. Since the management has not amended the financial statements, and if the adjustment is material to the context of the financial statements, then he will notify the auditee that the auditor's report should no longer be associated with the financial statements. Then he will also be required to notify the regulatory agency having jurisdiction over the client that the auditor's report should no longer be relied upon. So the regulatory agencies would be the ROCs or the SEBI, that the auditor report to this particular financial statement should no longer be relied upon. And the third bucket would be to inform each person known to the auditor to be relying on this financial statement. So basically there are three categories. First category would be informing the client. Second category would be informing the regulatory agencies. Third category would be notification to each person known to the auditor to be relying on the financial statements that his report should no longer be relied upon. However, in many cases, it will not be practicable for the auditor to give appropriate individual notification to the shareholders or investors at large, which is pretty common, and whose identities ordinarily are not unknown to him. In such cases, he will give notification to a regulatory agency having jurisdiction over the client, and this will be only the practical way, because if you are doing the audit of a listed company and if you want to withdraw your audit report, you will not be able to inform each and every shareholder. So in such cases, the auditor would inform the regulatory agencies. And whenever such request is made to these regulatory agency, it will be accompanied by a request that the agency take whatever steps it may deem appropriate to accomplish the necessary disclosure, which would typically be by way of a press release. So auditors would request the regulatory agencies that please issue press release so that the public at large comes to know about it. Then he may also want to seek legal advice on the matters, including those related to provision under the Companies Act. So auditors may think of taking legal advice in such situations, and very important, he will have to revoke the UDIN because he is now not associating himself with this particular audit report. So he will have to revoke the UDIN on the ICAI website. So this is the snapshot. In any case, I would be sharing it. Now, having understood scenario 1, scenario 2, let us go to the third scenario, which is facts which become known to the auditor after the financial statements have been issued. Now, the scenario which we saw earlier was where the financial statements were not issued. Now, in this scenario, the financial statements have also been issued to the public at large, to the concerned stakeholders. Now, when after the financial statements have been issued, a fact becomes known to the auditor that had it been known to the auditor at the date of the audit report may have caused the auditor to amend the auditor's report, the auditor shall, again, the same steps which we saw in scenario 2, discuss, determine, and inquire. If the management amends the financial statements, the auditor, now in the best case scenario, when both management and auditor comes to a joint conclusion that the financial statement need to be amended, and the management is willing to amend the financial statements, in such cases, the auditor shall carry out the audit procedures necessary in the circumstances on the amendment. Review the steps taken by the management to ensure that anyone in receipt of the previously issued financial statements together with the auditor's report thereon is informed of the situation. Extend the audit procedures to the date of the new auditor's report and the date of the new auditor's report no earlier than the date of the approval of the amended financial statements. So what this C part tells us is that he will have to follow certain audit procedures. And when he gives the new audit report, the date of the new audit report will not be earlier than the date on which the amended financial statements have been approved by the board of directors. So say for example, the amended financial statements have been approved on 23rd of June, the auditor's report cannot be dated earlier than that. And then the next step would be to provide a new amended auditor's report on the amended financial statements. Now, what would be the content of the auditor's report in such scenario? In such scenario, the auditor shall include a EOM paragraph or other matter paragraph referring to a note to the financial statements that more extensively discusses the reason for the amendment of the previously issued financial statements into the earlier report provided by the auditor. So whenever such scenarios happen, there will be a note in the descriptive note in the financial statements which will explain the reason behind revision in the financial statements, and the auditor's report, the new auditor's report will have a particular paragraph which will have a cross reference of the note given in the financial statements to explain the reasoning or the reasoning behind issue of the amended financial statements and new auditor's report. So that was the first best case scenario where the management amends the financial statements. Now let us take the scenario where the management does not take the necessary steps to ensure that anyone in the receipt of the previously issued financial statements is informed of the situation and does not amend the financial statements, where in the opinion of the auditor, the financial statement needs to be amended. In such case, the auditor shall notify the management or TCWG that auditor will seek to prevent future reliance on the audit report. If despite such notification, management or those charged with the governance do not take these necessary steps, the auditor shall take appropriate action to seek to prevent reliance on the auditor's report. So what will happen, to summarize, the auditor will notify the management that you should not rely upon this particular audit report which the auditor has already issued, and he will take appropriate action to seek to prevent reliance on the auditor's report. And what are the steps? Again, the same steps. So notification to the client, which is the first category, notification to the regulatory authorities, notification of each individual person, but that may not be practicable. So again, the notification would be to regulatory agencies only. And again, he may like to seek the legal advice about how we will proceed in such scenario. However, whenever he follows each steps which are mentioned in this particular standard, he will have to document it very clearly so that tomorrow he will be able to establish that whatever process he followed was in consonance with the requirements of this particular standard. And again, like we mentioned in scenario 2, since the management has not amended the financial statements and auditor is no more associating himself with this particular audit report which he had issued earlier, then he will have to revoke the UDIT on the ICAI report. Again, this is a snapshot of this particular scenario. Now, what are the UDIT implications? We have already seen what are the UDIT implications. Now, first scenario, when the management amends the financial statements and new audit report is issued, there will be two kind of things which the auditor will need to carry out. First is he will have to revoke the earlier issued audit report, UDIN of the earlier issued audit report, and he will have to generate the new UDIN for the new audit report. So there will be twin responsibilities: revoking the UDIN of the earlier audit report and generating the UDIN of the new audit report, which will be dated current. So which will be dated based on the date of the new audit report. Then in a scenario where the management does not amend the financial statements, then he has to do only one thing, in which is revoking the UDIN. Now friends, I have taken 3 case studies so to bring out the concepts very clearly as envisaged in this particular standard. So let us understand these 3 case studies. A fire broke out on 15th May 2021 in which material worth 50 lakhs, which was lying in the inventory since 1st March 2021, was totally destroyed. The financial statements of the company have not been approved till the date of the fire. The management of the company argues that since the loss occurred in the year 21-22, no provision is for the loss needs to be made in the financial statements for 2021. As an auditor, comment on the above scenario. Now, one thing is very clear that fire broke out subsequent to the balance sheet date, which was 31st March 2021. The auditor will have to clearly establish and come to a conclusion whether this is a subsequent event which requires any adjustment to the financial statement or not. He will follow the processes which are envisaged under this particular standard. He will have to also ensure that he is complying with the guidance given under AS4 or the equivalent Ind AS to check whether this is an adjusting event or non-adjusting event. If it comes to the conclusion that this is a non-adjusting event because the fire has broken out after 31st March, after the balance sheet date, and if he comes to a conclusion that it is not an adjusting event, then there will not be any adjustment to the financial statements. However, if we see AS4 or Ind AS, it says that if because of subsequent event, if it affects the very going concern assumption, then the auditor will have to ensure that the financial statements are suitably adjusted. So this is an exception to the non-adjusting event, though it is an event which is post 31st March. But if the fire affects the going concern assumption of the company, then it would become adjusting event, and then the auditor will have to ensure that the management adjusts the financial statements. Let us move to the second case study. A company limited has not included in the balance sheet as on 31st March 2021 a sum of rupees 1.50 crores considered to be a very material amount. and this amount is towards the areas of salaries and wages payable to the staff for last 2 years as a result of successful negotiations which were going on during the last 18 months and concluded on 30th of April 2021. The auditor wants to sign the balance sheet and give the audit report on 31st of May. The auditor comes to know the result of the negotiation on 15th of 2021 before the issue of auditor's report. As an auditor, comment on the above scenario. Now, friends, if we see the facts of this particular case study, there were certain negotiations which were going on between the management and the staff for past 2 years. Finally, the amount of the arrears was crystallized subsequent to the balance sheet date. Auditor comes to know about this before he signs the auditor's report. Negotiations got completed after the balance sheet date. As an auditor, whether it is an adjusting event or non-adjusting event, whether it is a subsequent event, again, the auditor would come to a conclusion based on the processes which he will follow. He will also take the guidance from AS4 and equivalent Ind AS. Now, the very fact that the negotiations were going on for past 2 years, only the amount has been crystallized post balance sheet date, but before the date of the auditor's report. This will become an adjusting event, taking cue from AS4 as well as AS29, which is on provisions, contingent assets and contingent liabilities. The auditor would ask the management to make provision for 1.5 crore in the balance sheet, and if the management makes the provision, everything is fine, nothing to be done. Auditor will give the clean report. However, if the management does not include this amount as a provision in the balance sheet, then since the amount is material as mentioned in this case study, the auditor will have to give modified or qualified audit opinion in this particular scenario. So in this particular case study, on 20th September 2020, the customer initiated legal proceedings against the company in relation to the breach of a contract. On 29th September 2020, the company's legal advisors informed the directors that it was unlikely the company would be found liable. So initially the legal advisors were confident that there won't be any liability against the company, and therefore no provision was made in the financial statements. But these were disclosed as contingent liability in accordance with AS29. On 29th October 2020, the court found the company liable on a technicality and now is required to pay damages amounting to a material sum. This sum is very material in the context of the balance sheet. The financial statements are for the period ended 30th September, and the annual general meeting is scheduled on 29th November 2020. The audit report has not yet been issued when these facts become known to the auditor. Since the financial statement, the date of the end of the financial statement is 30th of September, and this event has occurred during the financial year on 20th of September, because the legal proceedings were started, only the decision of the court has come subsequently. But before the issue of the auditor's report, this will be an adjusting event. The auditor will have to request the management that you make suitable provision for this particular sum. Again, two scenarios. If the management makes the provision, nothing to be done. If the management does not make any provision, the auditor would give qualified or modified audit opinion on this financial statements. Now, with these three case studies, I conclude my presentation, but with a small pointer that whenever we talk about subsequent events, we need to take very holistic approach while doing our audit. The auditor has to ensure that he is in compliance with the requirements of SA 560. And like I mentioned, in the context of SA 210, there is a technical guide or implementation, implementation guide given on SA 210 on auditing admin letter. Similar implementation guidance is available for SA 560 also. Again, it comes out with different sections. Initially, it explains the concepts, then there are FAQs, and then there is a checklist which is given. And I would recommend you to go through this very informative publication of the institute. Ensure that you follow the checklist. This checklist are present in your working papers so that tomorrow you can demonstrate that you have followed the requirements of this particular standard. Then requirement
Sorry. Hello.
the auditor has to be aware about these standards.
Hello.
Hello.
Yes, sir. Sir, last for 10 seconds, your voice got disconnected since your data got.
Yeah. So now I am audible now. Now I am audible.
You're audible, sir. Now you're audible.
Okay. So I will just summarize again. I'll just summarize again for the benefit of the listeners that there is a material available in the form of implementation guide on SA 560, which has got checklist also, and which should be there in the audit file of the auditors. There is also guidance which is mandatory under AS4, because AS4 is also gives the accounting framework. So auditor has to be about existing event or non-existing event. And then there is a guidance under the Companies Act in the form of section 130 and 131. These two sections talk about revision in the financial statements, which the auditors have to be aware. There are two sections. In one section, there will be a mandatory revision of the accounts based on the mandate of the government or regulatory agencies. In the second section, there is a voluntary revision of the accounts by the board of directors. So my whole point was that we need to approach this subject of subsequent event holistically by looking at different guidances available. Like there is also guidance for in SA 560 about the steps to be taken, implementation guidance, Companies Act requirements, A4. So the auditor will have to take holistic approach in this case. And with this, I conclude my presentation and thank you all for your patient listening. And if you have any questions, I am willing to take those questions.
Sure, sir. Sure, sir. Thank you so much for excellent presentation, sir, on standards and auditing. As of now, there are no questions. It seems pretty crystal clear on your presentation, sir. And
Thank you.
So if there is any questions, we'll request member to unmute themselves and they can ask, or else they can put it in chat box or question box. We'll take it up. We'll wait for 1 more minute, sir. And if not so, if there is any question that comes up to our mail ID after the session, after sharing this recording and presentation, we'll share it to you when time permits. You can respond it, sir.
Sure. My pleasure.
Yes, sir. And our treasurer is engaged with another meeting, so he couldn't join back again for a more vote of thanks. So we take a privilege in proposing vote of thanks, sir. And in chairman, secretary in their absence here, and our office bearers, we thank you so much for your time spent here.
Thank you so much for the opportunity given to me. Yeah. It is my pleasure. It is my pleasure.
Thank you, sir. We look forward to have you in physical presence also in future, sir.
Sure.
One minute. So we'll wait for 1 moment. If not so, we'll see. 1 minute. I'll just see any question.
Sir, can I ask question?
Yes, sir. Please, you can, sir.
Sir, regarding signing of balance sheet, the board approves and giving to the auditor for the auditor report and signing. So whether these two dates will be same or it can be different?
Normally these two dates have to be same, because when the auditor dates the auditor's report, he takes the responsibility up to that particular date. Generally, in 99% of the cases, you would find the date of the financial statements and the auditor report would the same, because the auditor asserts that since the board of directors have taken the responsibility for preparation of the financial statements, for the authenticity of the financial statements, we are also taking the responsibility for following our procedures up to this particular date. However, if the auditor, because of some reasons, some exigencies, the date of the auditor's report is subsequent to the date on which the board of directors meeting is held, or when the financial statements have been approved, then there is an additional responsibility on the auditor to follow certain processes, because then the date of the auditor's report would be subsequent, and if there are events which have been there between the date of the board of directors meeting and the date of the signing of the auditor's report, then auditor would be responsible if he does not reflect those events in the auditor's report or financial statements.
Thank you, sir.
Thank you, sir.
Thank you. Thank you.
So there are no more questions, and audience, if at all there were no more questions, we'll wind up the session. And if there's any question, you can post mail to sarccp@either@ica.in. The same will be forwarded to the faculty. Thank you so much, sir. We'll wind up the session.
Thank you. Thank you. My pleasure. Thank you.